Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. Tuesday, January 13th, landed like a controlled come-down. US markets finished a bit softer, still hovering near record highs, but the feel under the surface was very different. The tone was cautious. Not full risk-off, but definitely not all in either. The main story was a major AI pivot at the top of tech, which reshaped who's leading this market, while banks and some software names quietly gave ground. Look at the S&P 500 heat map and the story sharpens. This wasn't a broad sell-off, it was a patchwork. Alphabet and Nvidia showed up as some of the biggest green blocks on the board, while Microsoft and Meta were stark red, signaling rotation inside big tech, not any kind of abandonment of AI. Financials, led by JPMorgan, Visa, and Mastercard, were deep red sinks. In contrast, consumer staples, energy majors, and defense names quietly formed a band of green, giving the tape a defensive, selective feel. That heat map backdrop feeds directly into today's tension. After record closes on Monday, markets spent the day drifting sideways to lower, trying to reconcile friendly inflation data with fresh stress in banks. Leadership was narrow. A handful of AI platforms and chipmakers offset real selling in financials and parts of software. This isn't wholesale de-risking, it's late-cycle rotation. Investors are marking down credit-sensitive, high-valuation names and nudging capital toward defensives, hard assets, and a curated short list of AI winners, while they wait to see if earnings really justify these multiples. On the chatter side, one theme kept popping up on desks. How far can this AI concentration really go? Some portfolio managers are reportedly talking about trimming crowded, mega-cap AI baskets, worried that a handful of names are doing too much of the index heavy lifting. That's rumor, not a documented flow, but it fits the mood. People are questioning whether this leadership can stay this narrow without inviting a sharper pullback. So far, there's no confirmed sign of an AI unwind, just a market starting to test what's priced in. Apple just made its biggest AI decision yet. Instead of waiting for its own large language models to fully mature, Apple's chosen Google's Gemini to power the next generation of Siri and Apple Intelligence. This move is less about giving up control and more about speed. Gemini runs behind the scenes, while Apple still owns the user experience, the privacy boundaries, and the deep on-device integration. It's a familiar Apple strategy: partner on core technology, then differentiate through distribution, design, and trust. For the broader market, this reinforces a growing shift. Foundational AI models are becoming infrastructure, while real competitive advantage moves to platforms that control ecosystems, interfaces, and user trust. Alphabet sat at the center of today's tape. Google ripped to fresh record territory after Apple confirmed a multi-year deal to use Google's Gemini models and cloud for Siri and Apple Intelligence. That partnership effectively validates Google's AI stack and hands it a massive distribution channel across Apple's ecosystem. The stock's surge briefly pushed Alphabet into the roughly $4 trillion market cap club, alongside Nvidia, Microsoft, and Apple. On the heat map, Google was one of the biggest green blocks, a single name doing a lot of the work to keep growth benchmarks near their highs. Apple's stock reaction was much more measured than Alphabet's. Apple shares traded modestly higher as investors digested the Gemini partnership. The takeaway: this is smart triage for Apple's AI ambitions, not an overnight earnings story. The market seems to view it as a strategic upgrade that supports Apple Intelligence while leaving the core business model largely intact for now. That keeps volatility contained, but it also leaves plenty of open questions around regulation, competition, and how much AI economics Apple ultimately captures versus its partners. Microsoft landed on the other side of this AI reshuffle. Microsoft traded lower as money rotated out of some prior AI leaders following the Apple-Google deal. The company's still signing AI licensing agreements with publishers and expanding its ecosystem. But the narrative has shifted. Investors are now asking where the incremental AI economics really accrue, and whether Microsoft cedes some relative spotlight to a newly empowered Alphabet. On the board, Microsoft's red block underscored a new phase of selectivity inside mega-cap tech. On the financial side, JPMorgan was the key drag. JPMorgan sold off after its earnings and guidance underwhelmed expectations, even if they weren't disastrous on the surface. For a market priced for perfection, that was enough to pull the broader banking complex into the red and help knock the Dow notably lower. As the country's largest bank, JPMorgan's stumble reminded investors that the credit cycle and regulatory backdrop still matter, even in a market obsessed with AI. It also raised the stakes for the rest of bank earnings as the next catalyst for this rally. The pain in financials wasn't just about the banks. Visa and Mastercard both traded lower as traders focused on headlines around potential changes to lending and credit card practices. Those proposals could pressure fees and profitability, and that policy overhang showed up clearly on the heat map as deep red for the card networks. Together with JPMorgan, the moves in Visa and Mastercard turned financials into one of the ugliest pockets of the S&P 500. For now, it's pushing investors to pare back consumer credit exposure and look for sturdier income elsewhere. While leadership inside software fractured, Nvidia kept its footing. Nvidia managed modest gains as reports indicated that constrained H200 exports into China would still be allowed under new conditions. That kept its global AI data center story largely intact, despite ongoing geopolitical risk. On a day when some expensive tech names came under pressure, Nvidia's ability to stay green underscored its status as core AI infrastructure. For many investors, Nvidia remains the cleanest barometer of how confident the market is in the durability of the AI capex cycle. Away from equities, silver sent a different kind of signal. Bullion continued its powerful run, and the iShares Silver Trust, SLV, logged another solid gain. Investors are leaning into silver and gold as inflation hedges and as protection against lofty equity valuations. That quiet bid for hard assets, right as indexes hover near highs, suggests some money's hedging macro and valuation risk, rather than simply piling into the same AI trade. It's a subtle but important undercurrent in today's risk posture. So where does this leave the next few sessions? Earnings season is just getting going, with more banks and early blue chips set to test whether JPMorgan's stumble was an outlier or a warning. Housing data and credit commentary will help show how quickly lower long yields are reaching the real economy. In metals, traders are watching whether gold and silver's breakout can hold, pulling it together. This is still a market that wants AI exposure, but not at any price. Headline indexes sit close to highs, yet leadership is narrow and getting narrower, concentrated in select AI platforms, defensives, and hard assets. Banks, card networks, and some software are now under the microscope as earnings roll in. From here, watch how financials trade around results, how metals behave after this breakout, and how upcoming inflation and growth data shape the Fed story. That mix will tell you whether this is healthy rotation or the start of a deeper risk reassessment. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.